last class we had started with what is a financial institution and what are the features or characteristics of financial institutions, correct? Now we have understood what an institution or what is the role of financial institutions in the development or growth of our economy. It can be in terms of controlling regulation of monetary supply, it can be banking services, insurance services, pension schemes, etc. We looked at various types of services that these institutions provide for the development and growth of our economy. Today we'll be beginning with classification of financial institutions, right? Under what categories or under what classifications does these institutions work? We have three broad categories here: banking institutions, non-banking institutions, and regulatory institutions. Remember three: banking, non-banking, and regulatory. Under banking institutions, we have two types. One is commercial and the other is cooperative. Under commercial, we have subdivision, public banks, private banks, regional rural banks. It is commonly called as RRBs, okay, regional rural banks, and the last one, foreign banks. So, next is non-banking institutions. Here we have developmental and others. Developmental meaning IDBI, that is giving financial assistance to industries. SIDBI is giving financial assistance to exclusively small scale industries. Okay. NABARD is exclusively for only agricultural activities. Okay, for farmers, giving term loans and giving credit options, etc., exclusively for agricultural purpose. So these developmental banks are aiming at providing financial assistance or technical assistance for so that they would grow, and that growth would contribute towards the economic growth of our country. Is that clear? They are going to focus on specific sectors, small scale industries or large scale industries or agricultural industries. When these industries develop or when these sectors develop, they in turn will help develop or help the economic growth of our country. There are other kinds of non-banking institutions where it is called as equipment leasing, hire purchase, housing finance company. Now these are meant to make it easier, to make it familiar for companies in terms of acquiring your financial assets, where you cannot afford to purchase an asset, but either you can take it on lease or either you can do a hire purchase, not directly purchase in one shot, but at installment basis I will purchase the asset. Housing finance company deals with providing assistance in terms of construction or acquisition of a home or a house. The third category deals with regulatory institutions. Now these are the apex institutions, which is known as the foremost control and the foremost authority are with these institutions, like SEBI. SEBI is the watchdog of the stock exchanges in India. How the stock exchanges perform, what are the investors measures or informative measures that have to be taken to make sure investors are not being cheated with vague advertisements or very promising advertisements. In fact, RBI, we know Reserve Bank of India, is the head institution of all the commercial and the cooperative banks in India. They are the ruling or those who make decisions for all the banks in India, irrespective they are public, private, regional banks. They are the rule makers or monetary control. Monetary control is done by the RBI. Next we have IDRAI, where it deals with insurance services. Okay, now all kinds of insurance that you see, LIC, general insurance, motor insurance, all these insurance that we have come across, it is given up or it is regulated by IDRAI. Is that clear? So these are the regulatory institutions. Now let's study in detail the first one, banking institutions. Banks are a very important part of the economy because they provide vital services for both consumers and businesses. Now we all know banks are set up, or the idea of bank, or the entire concept of banking was introduced when Britishers were in our country, correct? Now they were the people who instituted this idea or the concept of banking, and then later it developed, and today the entire country cannot move their financial resources, they cannot shift their financial resources without this financial institution called as bank, correct? So banks are a very important part of economy. Today what we have as investment, mutual funds and all the other avenues of investment, back then banks were the only source of investment of our money. Instead of keeping our savings with ourselves, what people used to do is open up bank accounts. Even banks also have developed in their kinds of services that they provide, okay, technical service, technical advice, giving overdraft facilities. All these various types of accounts have been recently developed, but the basic aim or why banks exist is just to accept deposit and lend loans. Is that clear? A bank is a financial institution which is licensed to receive deposits and make loans. This is the primary motive or objective of why a bank is set up. All the other functions of bank that we hear are the additional functions or services, but the primary or important objective is accept deposit and lend loan. What are the different types of banking institutions? There are commercial banks and there are cooperative banks. Now, why is this difference called as commercial and cooperative? Commercial meaning they are focusing on making profit. There, yes, they are providing service, but their motive is profit making. Cooperative is, as the name itself says, they are able to cooperate with the people who are underprivileged or people who cannot afford to make a decent living with terms of agriculture, or with people who have lesser low income status. Got it? So commercial is aiming at profit making, cooperative is aiming at helping the poor people or helping the people in the rural area. Let's look at the commercial banks classification. First one is public banks. These are the nationalized banks and account for more than 75% of the total banking business in the country. Majority of stakes in these banks are held by the government. Okay, public banks are called as nationalized banks and account for more than 75% of total banking business. Now today whatever banks that exist from throughout the entire Indian economy, majority belongs to public banks. That means more of control and more of equity stake is held by whom? It is held by Government of India. Now, compared to public or private, which is more secure for investment or which is more secure for our, deposits, it would always go for public banks. You got it? Because why? Their stake majorly is held by Government of India, and that's the reason we have more security or trustworthiness towards the public banks. So in terms of volume, SBI is the largest, that is the State Bank of India, is the largest public sector bank in India, and after its merger with its 5 associate banks, if you can remember, that was couple of years, just a recent news where SBI and its associates, like let's say Bank of Travancore, Mysore, Hyderabad, etc., right? All these banks were clubbed along with SBI. They were functioning independently, but then on 1st April 2017, they got clubbed up or they got associated or merged with the main SBI bank sector. And one of the major reasons why these banks were merged is because of the growing NPA. What is NPA? It is non-performing asset. What is an asset to a bank and what is a liability for a bank? If you think deposits is an asset to the bank, that's wrong. Because even deposits for us is an asset, because when we keep open RD account, FD account and keep 5 lakhs in the bank, after 2-3 years, maybe the time period, I am going to get back the entire 5 lakhs amount plus the interest earned. But for the bank, it is not so. how many ever people open deposits account in the bank has to pay interest. Remember, bank has to pay interest, paying, right? Now, anything that we have to pay is definitely not our asset. It is our expenditure or liability. Therefore, all the deposits held by any kind of bank is called as what? Liability or an expenditure. Then, what is an asset for a bank? Loans are an asset for the bank because banks lend loans and the interest that is charged on the loan amount taken, does the bank pay for it or does the bank receive it? Bank receives interest. Okay, if you are taking a loan from a bank, along with the principal amount, you have to pay additional interest. Remember, you are paying and the bank is receiving. So therefore, because bank is going to receive that amount, it is called as asset for a bank. Understood? Deposits are a expenditure, loans are a asset for the bank. Now, why did I say this? Because of the concept of non-performing asset. Now, as long as all those people, individuals or institutions, whoever have taken loan from the bank, if they return it promptly or make the principal payments or the interest payments timely, then it is a good. It's a performing asset. Asset is performing for the bank. Now, what if in the case of Miss Malia, right? Vijay Malia, what did he do? Right? He took an enormous amount of loan from the different banks and then failed to repay it back. Now, is that a performing asset or is that a non-performing asset? It's a non-performing asset. So, any individual or any institution who borrows loan from the bank but fails to make the payment back to the bank, that is principal plus interest, in a timely period is called as non-performing asset. Is that clear? So, the very reason this banks were merged or the associate banks were merged with the head bank is a reason to avoid this NPA. Got it? Avoid this NPA. So, each of these associate banks had huge number growing in non-performing asset. Now, if this is going to increase, non-performing asset is going to increase for each bank, is that a good sign of growth of a bank? No. It's a dangerous sign, right? That bank is running short of funds, correct? Now, therefore, SBI started associating or merged all its sub banks to itself. That way, bank, that is SBI, being the largest public sector bank, has more deposits, has more bank balance to cover up the NPAs of its associate banks. Is that clear? This is the whole idea or the whole concept behind why SBI has adopted or has associated with its other 5 banks. Is that clear? So, these are called as public banks. Majority of stock is held by government. Now, on a scale of 100, okay, now anything above 50, okay, anything above 50 will make what? Majority, correct? So, the stake of government held in these public banks are 51%. Is that clear? So, anything above 50 will become major stake, correct? So, the rest of the 49 is held by private individuals or institutions, etc. But government is holding what? Majority stake in this public banks. Hope you have understood the entire concept of public banks. Moving on to the second part, private banks. These include banks in which major stake or equity is held by private shareholders. Remember, major stake in public bank is held by whom? Government. Here, it is held by private shareholders. All the banking rules and regulations are laid down by the RBI will be applicable on private sector bank as well. Now, if it's a question, does private banks have to register themselves under the RBI or Reserve Bank of India regulations? Yes. All the rules that are applicable to public banks also are applicable to private banks. Okay. So, but the major stake is held by, or the majority of control is held by whom? Private shareholders. So, here the government stake may be less than 50% in private banks. So few of the private bank examples are IDBI, S Bank, Axis Bank. So these are the few private banks. Number 3 is regional rural banks, commonly called as RRBs. These are also scheduled commercial banks, but they are established with the main objective of providing credit to weaker sections of the society. What is the major aim of RRBs? Providing credit to weaker sections of society like agricultural laborers, marginal farmers and small enterprises in rural areas. They usually operate at regional levels in different states of India and may have branches in selected urban areas as well. Now these, as the name itself says, regional, rural, these are meant to help the people in the weaker sections of the society. Now remember, the rules laid down for public and private may not be easily or the same applicable to regional rural, because these public and private banks are set up in urban areas where everything is developed. There is access to everything. There's access to health, there is access to finance, there's access to technology, there's access to transportation, etc. But in rural areas, is it the same? Definitely not, correct? So there is a lack of accessibility to comfortability or accessibility to few of the pleasures that is only available in city life or only available in urban cities. Okay, the developmental activities are not applicable or not available in the regional rural banks. Now, so here the banks have the major objective in providing credit to weaker sections of society. So, if they're charging in the public bank for a loan of rupees 2 lakh, let's say the interest is 10% for an example, you cannot charge the same for a regional rural bank. Clear? Because their affordability is less, the standard of living is less, or their pay scale is less, etc. Correct? So you cannot charge the same amount. Maybe you have to reduce half that amount. Okay, maybe 4 to 5% on 2 lakh. Got it? So even the way you function and all the rules and regulations may not be as strict as public or private banks, but it will be more simplified or more affordable for people in the rural sections of the society. Moving on to the fourth point, foreign banks. A foreign bank is one that has its headquarters in a foreign country but operates in India as a private entity. Remember, where is the foreign bank's headquartered, established in a foreign country, but it has a branch operating in our economy called as a private entity. These banks are under the obligation to follow the regulations of its home country as well as the country in which they are operating. Examples, HSBC and Citibank. These are the two banks those are foreign banks in our country. So they are headquartered in different countries, but then their private entity is set up in our economy. So what are their obligations, or what are the rules and regulations are? They need to follow up both the home country wherever the headquarter is established, those basic rules, let's say the subscription of capital or the holding of equity, who is holding the major share of equity. Okay, for public banks we saw government of India is holding. So for foreign banks, it is their own home country government may be holding the majority of stake. So few of the interest rates, when they are deciding or making a decision about interest rate charging on the loan, they need to understand wherever they are situated, I mean the branch is situated. Now if Citibank is situated in India, maybe its headquarters is in America for an example. Now the standard of living and the affordability in USA is far different from what we have in Indian economy, correct? Therefore, they cannot charge the interest rate as high they used to charge in their headquartered country. So, they need to alter or they need to make certain choices or decision even according to the country where they are operating in. Is that clear? So they need to abide by the rules of the home country and also in the operating country. So these are the 4 different banks under commercial banks heading. The second part is cooperative banks. They are registered under the Cooperative Societies Act of 1912 and they are run by an elected managing committee. These work on no profit, no loss basis and mainly serve entrepreneurs, small businesses, industries, and self employment in urban areas. In rural areas, they mainly finance agricultural based activities like farming, livestock, and hatcheries. Now, remember, as I told, societies bank are aimed at providing services or helping, in simple, helping people. Okay, who are the people they help? Entrepreneurs, small business units, self-employed. Now people like tailors or people who are cobblers, right, in the rural areas, right, a small finance that they require to run a small shop or a small financing unit. Okay, so these cooperative banks do not look at high interest rate because they're not aiming at making profit. They're aiming at providing service or helping people in the rural areas. Is that clear? These work on no profit, no loss basis. And the same manner, that doesn't mean they keep helping people and not expecting anything in return or even the return of principal amount. Okay, just to make sure they help, but rules and regulations comparatively what we have for a commercial bank, those are not applicable for cooperative banks. These are more simpler and more affordable rate of interest or deposits, etc. Because they're aiming at people who are self-employed, small businesses which cannot move up to a larger investment scale. Got it? So today we have learned about the classification of financial institution. We have learned what is a banking institution, what is the objective, major objective is accept deposit and make or lend loans. Under that we have 4 categories: public banks, private banks, regional rural banks, foreign banks. The second part is cooperative banks.